Okay, hello everyone. I'm Lou Kerner with Crypto Mondays, now in VR and Crypto ZTV, and I'd like to welcome you to the second episode of Stablecoins Are Killing It, featuring three thought leaders who are going to share their view on the stablecoin ecosystem. We're going to be joined today by Ryan Watkins with Masari, Joao Reginatto with Circle USDC, and Ganesh Viswanas Nitraj with the Warwick Business School in the UK. So we've got a nice international panel here today. Each of our speakers are going to speak for 5 to 10 minutes, and we're going to spend the rest of the time taking questions from the audience. So please ask questions at any time via the Q&A tab on Zoom. And if we take your questions, I'll chat with you saying, your question's next. And we'll open up your mic and your video so you can ask the question yourself and any follow-ups or engage in a dialogue if relevant. What we're going to do to get as many questions as possible, I'm going to ask each of the our three thought leaders today, when they're answering a question, to keep the answers to 60 seconds, 1 minute, so we can get to as many questions as possible. Lastly, these calls were recorded and are going to be posted on YouTube. And so with that, we're going to start the call with Joao Reginatto with Circle USDC.
Thanks, Lou. Thanks for having me here. By way of introduction, I'll just briefly talk a little bit about myself and what I do at Circle. So I'm originally from Brazil, have been in tech for just under 20 years now, and have lived for almost the last 15 years outside of Brazil, mostly in Dublin, in Ireland, but also spent some short time in the US before, and in France, and now I'm based in Boston for just under 2 years. As I said, I've been in tech for a while. I'm a former software engineer, led teams of engineers, and did IT architecture as well, until I decided to go to the dark side of the force, as people said to me, and do a business degree, and that was in 2012, and that was my first introduction to crypto. There was a colleague of mine who just wasn't paying a lot of attention to lectures, and I asked him, why he was doing that, because those, programs tend to be pretty expensive, and he said he had found out about this thing called Bitcoin, and he just, he was in the rabbit hole and he couldn't get out. So we started talking about Bitcoin a few evenings after courses, and I just thought it was fascinating. I bought some Bitcoin, played with it, kept discussing it, but never did anything professionally speaking about it until 2015 when I got a call from Circle talking about a job proposition. And I had been following Circle before, because one of the things that I was talking to, this circle of friends that developed an interest in crypto was just the ease of use and how that could develop over time. So I was obviously tracking Circle, because since Circle came out of stealth, I think in 2014, it was clearly a significant improvement in terms of user experience for people using crypto. So I joined Circle then in 2015, as I said, have been working on the product team since then. First of all, in Dublin, in Ireland, and I joined, and my mandate was to basically expand our Circle Pay product at the time throughout Europe. But our vision in Circle since the beginning was always to, bring the ethos of data on the internet to finance, right? So why is it that money doesn't really work as data on the internet, and why is it that it's very siloed, very regional, very cumbersome, very expensive, and very slow moving compared to all the other media and other types of content that we're used to, and how fast and cheap and global that is today based on the internet. So we in Circle then, we attempted, we're very stubborn with that vision, but we were very flexible with how to try and achieve that vision. So we tried building consumer products that would abstract away and sort of use crypto in the form of Bitcoin at the time, the first incarnation of the product, as a way to then connect what at the time was a peer-to-peer payments product to potentially a much broader ecosystem, right? So you could transfer money just as you do today with Venmo and all those apps. You could transfer money to your friends within that app, but if you wanted to transfer money outside of the app into other platforms, into other products, that you could use Bitcoin to do that. I think that was the imagination that was there at the time. I think over time people realized that Bitcoin is not quite that crypto asset that allows you to implement that sort of interoperability at a protocol layer. And so around 2016, 2017, obviously a lot of people in Circle started to pay attention to what was going on with Ethereum, because of all the programmability aspect of it, and the fact that you could create your own assets, and obviously change the quality attributes of them so that they could behave a little bit more as a protocol. So we experimented with a few ideas there. We experimented with the idea of creating our own tokens, and how a token that actually an end user perhaps doesn't need to touch directly, but how that can be used again as an interoperable layer for communicating across all of these financial products and services. Until we actually realized that we didn't want to build just yet another token, but what we really needed was a stable coin, and that obviously came with the advancement in the concept of stable coins. That particularly was going on with Tether, I think, in 2017 and 2018 then, and the significant growth that happened in that space, even though Tether as a concept and even the broader concept of stablecoin is a little bit older than that. So we realized, okay, if we are to take a stab at this sort of solution to try and achieve our vision, then we have to build our own stablecoin, and we can talk about the decision making that went through our minds in terms of how we go about doing that. What's the design? What are the preferable attributes for a stablecoin? But also we need to rewire the infrastructure, the platform that we had built over years that sits underneath all of our consumer products to represent money in that way, right? Because obviously that would deliver the benefits for our customers and for the business. So that was 2018 at that point, and I led then the build out of USDC for Circle at that point. At that point, it was still a very Circle idea, and but quickly working through the design of what we thought would be a good stablecoin that the market still needed. We obviously, thought that doing fully fiat collateralization was the way to go. It was a simple design, and we were quite comfortable with the regulatory and compliance and legal aspects around money transmission. We had been doing that for years in the US and in Europe, so we were comfortable with that design. But also
So as you were doing this work, who did you get inspiration from? What other projects, that we were able to learn from? Say, well, we're going to take this piece and that piece.
We were looking at everything that was going on in the space at that time. So we probably had on our radar, pretty much every other stablecoin project that was being worked on. Obviously, Tether, DAI, the more, the previously decentralized options that people were playing with. A lot of those projects actually ended up dying or never seeing the light of day, but we were either in touch or following very closely pretty much every solution, every possible design solution. One of the things, and we had Circle obviously had this is if you're thinking about a timeline, this is going in parallel with everything else that's going on in the company, right? And one of the things that Circle was very successful at the time was the trade desk. And with the trade desk was a good way to just get in touch with a lot of these very important actors in the crypto ecosystem, right? Liquidity providers, market makers, and so we could tap.
When you say a trading desk, it's more OTC, like you guys are on the phone.
Circle's OTC trade desk is exactly, yeah. And so you could, and I had a ton of conversations with folks on those roles, to really understand what is it that makes a stablecoin good or bad for you, and we knew that there was a lot of traction in that space, and so we used a lot of that feedback. Certainly, one of the things that came up, for example, in those conversations was counterparty risk, So obviously a more centralized solution such as USDC and such as any fiat collateralized stablecoin has a level of counterparty risk that people always ask the question about it, right? So people always say, what if Circle goes bust? What if Coinbase goes bust? What if the bank that holds the reserves goes bust? People always think about those catastrophic scenarios because you have those choke points in the solution, right? And so we said, okay, how do we try to minimize that counterparty risk? And the idea behind the Central Consortium, which is now the body that governs USDC and all future stablecoins, that's when the idea came from.
That's a 50-50 partnership between the two companies?
Right now it is, but it's also an open model, and it welcomes participation from other companies. And I think we will see, hopefully in 2020, more companies joining. But certainly there's always a number of people that are thinking about how we can continue to increment the participation on the consortium. So,
and so when did it go live?
It's tricky. I don't know what you can call the event that actually says this went live. As a legal entity, it was formed, I believe, in 2018, 2019. It went through a couple of changes in the format. Then we did like a proper marketing launch. Then we conceived policies, written down policies to say, if a new issuer joins Center, this is what they need to abide to. So it's probably a process rather than a point in time where you can say it went live. But certainly
trading. Do you remember when it started trading?
You mean what exactly?
The coin. You buy the coin, sell the coin.
USDC. Yeah, USDC was in September 2018. That's when it went live, as far as the live on the exchanges, and you could trade on exchanges. And we had USDC present on a good number of exchanges out of the gate. The first few USDC were minted in, I believe, in around the end of August 2018, something like that. So anyway, so we, as I was saying, the counterparty risk discussion was what fed this idea of a consortium of companies. So you don't have a single issuer, you don't have a single company that is capable of issuing and redeeming USDC. You actually have more than that, and hopefully in the future more than Circle and Coinbase. So Coinbase joined the consortium in end of 2018 or beginning of 2019, something like that. And then USDC was out in the wild, and it was growing. And 2019 was an interesting year. I think we achieved all the expectations that we had for it. But then 2020 came, and then we are just literally feeling like we're sitting on a rocket ship. It's growing tremendously. We see tremendous interest from both a consumer and end user point of view, to be able to hold it and hold digital dollars anywhere in the world, but also from businesses around the world to utilize it really as I think we had a vision for in the beginning, which is if you want to build a product or a service, whether there is a financial product or service or any product or service that needs to represent money for their end users. How do you go about picking the solution for that? And you can pick the traditional solution, which is, let's hold value on a bank account, and let's use banking APIs or payment processing APIs to process transfer of value on top of that. Or you can use crypto as a technology, right? And you can use USDC for that. So that is basically where we are now, as far as Circle, as far as a company. We're basically focusing, given all the traction that we saw with USDC, and we thought, this is one of those point in times, probably when we're going to look back and we're going to think we are in the right place at the right time. So let's put a lot of resources behind USDC, because we believe, and our customers are giving us validation of this, that this is stablecoins in general, but obviously we have a preference for USDC. They're just a tremendous alternative for representing value in terms of the infrastructure that you have. As a business, and every business needs to represent value in one way or the other, whether it's in a more simple way to pay and receive payments from their supply chain, or if it's in a more sophisticated way because you have a marketplace, or because you do commerce and you want to process payments from your end users, and so on and so forth. So we offer APIs for developers that are helping shape these businesses and want to build something that is more akin to how how data works on the internet, because then obviously the settlement and the payments that you support as a business can move a lot faster, a lot cheaper, and can be global from the get-go.
Yeah, and we're just at the beginning of that innovation. That's a great overview on what you guys are up to, and thanks for sticking around for the Q&A afterwards. And now turn it over to Ryan Watkins with Messari. Hey, Ryan.
Hey, how's everyone? So like Lou mentioned, I'm a researcher at Messari. I've been here for about 7 months, and I cover currencies and stablecoins. And I have particular interest in money and governance. Before Messari, I've spent a couple of years in investment banking. Before that, I was at Fordham University studying finance and computer science. So I think I want to share with you guys today is a kind of bird's eye view of what's happened in stablecoins over the past, really year, but especially the past 5 months. Kind of like what was mentioned in what's the title of this panel is that stablecoins are killing it. And they've seen explosive growth over the past 5 months, particularly in the months following the coronavirus.
Hey, Ryan, are you going to share your screen to
Yep.
share your slides?
All right.
Perfect. There you go.
Yeah, so I think if there's one takeaway you have from all these slides is that US dollars are being ported onto public blockchains. So historically, if you think about, what are the two dominant blockchains for transferring value? Those are, Bitcoin and Ethereum. And really over the past year, you've seen stablecoins start to really each share of the total value transferred over these chains, now reaching as high as 40% of the value just on, Ethereum and Bitcoin alone. Kind of like when you dive under the hood, it's like, okay, well, the stablecoins are growing, but where we've particularly seen the growth take off was in the midst of the coronavirus. So in Q1 alone, stablecoins added nearly as much market cap as it did in the entire year of 2019. So about $2.5 billion in Q1. Literally all of this was added in March, actually. So the month of March alone saw $2.5 billion in stablecoin issuance in just that month. And this trend has continued. So, to start the year, we are around, $6-ish billion of stablecoins issued. And that's grown to nearly, $10 billion really since March, as there's been a significant flight to cash, from some of the volatility we've seen in crypto markets. And also,
I'm sorry, you said a significant flight to?
Significant flight to cash. Yeah, to shield from some of the volatility we've seen in cryptocurrency markets and also broader financial markets. So who have been the winners so far? So I think at a high level, I think the biggest winners so far this quarter have been, or this year have been Tether, USDC, BUSD. So BUSD, had the benefit of, growing off a pretty low base to start off the year. In January, on January 1st, 2020, BUSD had only issued about $30-ish million worth of stablecoins. And this year, they've so far issued $150 million worth, which is significant growth. And in large part, what that is Binance has been running promotions for BUSD, where you can save on fees for being a liquidity provider on Binance, which has definitely helped, buoy the growth. And it's funny, they actually initially launched this promotion back in late 2019, but have since extended it 3 times, due to the success they've seen with BUSD. And I think second to highlight here is Tether. So you think, although right here it's the 3rd fastest growing on the year, you think BUSD had the benefit of growing off that low base, and DAI actually had the benefit of the transition from single collateral DAI to multi-collateral DAI, which has helped kind of support those growth numbers for DAI. And really where all the stablecoin issuance is happening is on Ethereum, right? So I think when stablecoins were first introduced, kind of touched on this before, I think it was around 2012 in the Mascorn white paper is when stablecoins were kind of first conceptualized. And the first stablecoins were actually issued, Tether specifically, on the Omni protocol, which is a second layer protocol on Bitcoin. And so it existed for a while, but it was really recently, really since kind of late 2018, we saw a lot of stablecoin issuers announce new projects. We started to see the growth of stablecoin, particularly on Ethereum. And one big major story over the past year is Tether's transition from Omni on Bitcoin over to Ethereum. And you kind of see how the market for stablecoins has developed over the past year as Tether has migrated over to Ethereum. Perhaps the biggest story with all this is that stablecoins have brought the total amount of value that is being transferred on Ethereum to parity with Bitcoin. It's pretty interesting. So this pretty much tells you that, and this only includes stablecoins. This doesn't include any other tokens that are issued on Ethereum. But what it's telling you is that, kind of spurred by stablecoins, Ethereum is emerging as the dominant chain for transferring value, right? And this is supported by people's desire to want to transfer value in a stable asset. For a long time, stablecoins were thought of kind of like the holy grail of cryptocurrencies, and that you could get many of the benefits of transacting on public blockchains, but with doing so in a stable currency. And I think that's in part what we're seeing is people now that they have the option to, they're familiar with stablecoins now, electing to transfer value in them as opposed to some of the volatile crypto assets like Bitcoin and Ether. So kind of like another chart that kind of shows how value is being transferred on Ethereum now is, stable coins, over the past year have grown from, just around like 20% of the value that's transferred on Ethereum all the way up to 80%. So you're seeing that Ethereum is emerging as the dominant kind of settlement rails for these stable coins that are Probably the final chart that I want to share today is, although Tether being issued on Ethereum, was very low in January. The full picture of the stablecoin market kind of shows how, Tether has been the dominant stablecoin over time, really since 2019, and then kind of recently, you see some projects trying to chip away at that, kind of attacking Tether from different fronts, whether it be through real world business use cases like Circle's doing, or through use in DeFi, the central finance on Ethereum, like DAI, just trying to find creative ways to start chipping away at Tether's market share.
Hey, Ryan, when you've looked at the stablecoin marketplace, are there any ways that you can divide it up, like say by geography? Are they more used in certain geographies in Asia? Say, you mentioned Binance's coin, or is there any other way to think about dividing up the market?
Yeah, so I think probably the best way to divide the market is really to divide it between, fiat collateralized stablecoins and crypto collateralized stablecoins. This is the two, dominant models for issuing stablecoins. And the fiat collateralized ones are ones like Tether and USDC, and those are kind of digital IOUs on a blockchain that represent dollars in a bank account. Whereas the crypto collateralized stablecoins are like DAI. Kind of represent a claim on a crypto asset, particularly Ether, that's being held in a smart contract that supports the value of the stablecoin. So those are probably the two different models for these stablecoins. So far, has that translated into users preferring one or the other? It doesn't seem like it that much. And it seems like users are comfortable using kind of the fiat collateralized stablecoins, despite the fact that they are centrally issued. And as far as like geography, I don't think I would be able to provide a ton of insight there. But I know, like, if you think about Tether specifically, in 2017, when you had the big bull market, the way that Binance didn't have any bank accounts, so the kind of the way that they would store their balances, like the money they make, would be in these stable coins and crypto assets, and they were in Asian-based exchange.
Okay, cool. Ryan, again, thanks for sticking around. And so what we try to do on these calls is have people who come at our topics from different angles. And so I'm excited for our last speaker, who's going to come at it more from a kind of from an academic viewpoint. He's done some super interesting work, diving into a lot of the data on what's going on in terms of stable coins. And so with that, turn it over to Ganesh. Ganesh, I guess you did some early work at UC Berkeley, and now you're at the Warwick Business School in the UK.
Yes, thank you, Lou, for inviting me to this very interesting presentation. So I just finished grad school at UC Berkeley last year, and since my first major project since completing grad school is on stable coins, and so we essentially started looking at Tether and other stable coins and tried to think about the potential mechanisms for stability, and thinking about why stable coins can trade at a premium or discount. So I have a few slides that I'll share now.
And Ganesh, before you did this, did you have a background in crypto, or what brought you to these, to write this paper?
Yes, so it was not my intention to go into crypto space immediately. So I guess my background is mainly in foreign exchange markets. And so Richard Lyons, a co-author on my paper on stablecoins, then told me about stablecoins and thought there was an interesting angle from the point of view of thinking about fixed exchange rate regimes and how we have a new context for it with stable coins. And so that was our starting point. And so to kind of start off my talk, I'll just detail here a little roadmap of what I'll talk about. So first I'll talk about kind of the key messages of the research on stable coins. And I will briefly talk about the sort of controversy surrounding whether Tether is manipulating Bitcoin and cryptocurrency markets. And I will finish with a discussion of what I think are important issues in the future of stablecoins. And both Hao and Ryan have already talked a little bit about some of these topics, but I will add to that, particularly with an emphasis on Libra. So that's obviously a major sort of initiative over the last few months, and they just released a new white paper, and I'll go a little bit into my thoughts on whether Libra, as it currently stands, is a viable currency or not. Okay, so my main research on stablecoins, so this is very current paper, and I've gotten a lot of feedback of it, and the response has been great. And the idea is to tackle two questions. So the first question is, given that stablecoins are generally decentralized arrangements, how do you achieve stability of the peg? So the idea is to maintain parity with the dollar, but sometimes you can go at a premium, sometimes at a discount. So what mechanisms exist to stabilize the peg? And so we argue that there are arbitrage flows. So investors can come in and deposit dollars with the treasury and sell newly created tokens in the secondary market when the peg trades above parity. And they can redeem their dollar deposits when Tether or other stable coins trade at a discount. And the second question is thinking about why stable coins can trade at a premium or a discount. And so here, if we think about fixed exchange rate regimes like the peso, so when Argentina and Mexico had peso pegged to the dollar, they typically traded at par or at a discount, and the discount is due to risk of the central bank running out of reserves, for example. But then stable coins trade at significant premiums, especially in periods of excessive risk in Bitcoin and crypto markets. Okay, so to tackle the first question, I will outline the arbitrage mechanism that we have in mind. So the idea behind this arbitrage mechanism is that if Tether trades at a premium, so let's say it's $1.05, then an investor has an incentive to deposit dollars with the treasury and create new Tether tokens and then sell that in the secondary market. And so on the right figure, you see this investor depositing $1, getting 1 Tether and selling it in the secondary market, and they make an arbitrage profit. And so empirically, we find that deposits with the treasury tend to coincide with positive deviations of the peg. So on the left plot, we have the price of Tether in terms of US dollars. And when Tether trades at a premium, we have on the vertical axis, we're plotting the flows from Tether treasury to the secondary market. So in general, there's a positive flow from the treasury to the secondary market when Tether trades at a premium. And conversely, there is a negative flow when Tether trades at a discount. And this is consistent with this arbitrage motive. Okay, so that's essentially the first part of the paper. Now, the second part, which Ryan nicely pointed out, is the introduction to the Ethereum blockchain. So this, we find evidence that this increased the stability of the Tether peg. And the idea is simple. So if we look at the middle diagram here, so before 2019 April, there's really only one address that's transacting on the Omni layer with the treasury. And so this is Bitfinex. So in the Omni layer, what typically happened was Bitfinex deposited dollars with the Tether treasury, got an equivalent number of Tether tokens, and then distributed those Tether tokens to other exchanges. But since 2019 April, we find there's a big increase in the number of addresses that are transacting with the Tether treasury. And that is due to investors transacting with the Tether treasury on the Ethereum blockchain. And so the red, that big increase coincides with the Ether scan. So that's essentially the recordings of transactions on the Ethereum blockchain. And so the fact that the number of unique addresses transacting with the Tether treasury resembles the rightmost figure. So now, instead of exchanges going to getting their Tether from Bitfinex, they're getting their Tether directly from the treasury. And this increases the arbitrage opportunities. So if a larger set of investors can now access dollars directly, also can now create Tether tokens directly with the Tether treasury, then that enables them to carry out the arbitrage mechanism. So that's quite a significant event. And we find that following this event, the deviations from the peg are much smaller, and deviations also tend to revert back to zero quicker. So there's more efficiency in the arbitrage mechanisms of the system. And we hypothesize that this is largely due to the increased investor access on the Ethereum blockchain. Okay, so now the second part is dealing with stablecoin premiums and discounts. So stablecoin premiums typically occur in periods where Bitcoin and other cryptocurrencies are very volatile. So this coincided with the crash of Bitcoin in early 2018. And then we find Tether trades at a premium. And the idea of the safe haven effect is that in times of crisis, investors want to liquidate into a store of value, and they can either liquidate into a stable coin or dollars, but as stable coins are on the blockchain, it's much more convenient to rebalance your portfolio to stable coins. Whereas if you go through dollars, you incur more intermediation costs, where there's evidence that going from dollars to crypto takes more time than going from crypto to crypto. So in terms of latency time of transactions. And so the fact that you can liquidate to stable coins is a much more preferred alternative. And that's what's giving rise to this stablecoin premiums. Speculative attack, there's one nice example in October 2018, where Bitfinex suspended convertibility of dollar deposits. And this led to speculation that Tether was not fully backed by dollar reserves. And because of this, Tether collapsed temporarily. And as soon as Bitfinex restored convertibility, it went back up. But this was a nice example of if the dollar-backed stablecoin has insufficient collateral, then that can lead to a speculative attack. And so we are very...
Well, but I mean,
Yeah. Yes.
Whatever it was the day before the drop, it was the same thing the day after. So it wasn't the fact that they didn't have full collateral. It was the fact that the market's view changed.
Yes, exactly. So the speculative attack, yes, it's more about expectations of whether the system is fully collateralized or not. And so there are numerous examples in fixed exchange rate regimes. So like if you think about the peso crises, it's due to speculators thinking there's insufficient reserves. So we see essentially an analogy in the stablecoin space. And of course, the most recent episode on March 12th, where Bitcoin fell by approximately 50%, we see large stablecoin premiums for the 6 largest stablecoins. And so this is not just a Tether unique effect, that this broadly applies to the class of stablecoins, that they're preferred store of value in times of increased risk in cryptocurrency markets. Okay, and another thing to think about the safe haven effect is there was also a lot of congestion on the Ethereum and Bitcoin blockchains during this period because investors wanted to liquidate quickly. And so when investors want to liquidate quickly, stablecoins is a much preferred store of value than dollars, where it can take some time. So that's kind of the main reason why you can get these significant premiums, that people are willing to pay extra to hold a stable coin simply because it's much quicker to rebalance.
Cool.
So now I want to touch briefly on a little note I did that with Rich Lyons, my co-author, that follows on from sort of the discussion of the Griffin and Shams market manipulation hypothesis. So what we did is we constructed the Tether balance sheet, and then we have a measure of the flows from the Tether treasury to the secondary market. And so what we find is that when we look at Bitcoin price changes and trace the effect of Tether flows on the Bitcoin price, we find no systematic effect. And this is after controlling for things like sort of feedback effects with lag prices and flows. So our main finding is that we don't find a systematic effect of Tether issuance on Bitcoin prices.
Interesting.
So obviously a key point of discussion is, why do our results differ from Griffin and Shams? So I think a very important point to note is that the flows that we use is a different measure of flows. So we are taking aggregate flows from the treasury address that we found on the Omni and Ethereum blockchain to the secondary market. Whereas the Griffin and Shams measure of flows is recording periods of high flow from Bitfinex to other exchanges, so flows of Tether, and corresponding flows of Bitcoin from those exchanges back to Bitfinex. And so the main finding is actually that this Bitcoin whale that is essentially using Tether as the vehicle currency to buy up Bitcoin, and they're finding evidence that this Bitcoin whale had significant effect on Bitcoin prices. So our methodologies are very different. In terms of which methodology is more appropriate,
Ganesh,
yeah.
This is great stuff, and you know, hopefully we can come back to it during the questions. But I want to leave some time.
Okay.
For the questions, you know, which can include Libra, because I know you've done some great work on Libra as well.
Okay.
And so for the first question, we've got Luca. Luca?
Yeah, hi. Thanks for allowing me to pose the first question. Can you hear me?
Yep, we can hear you well, and we can see you.
I'm sitting in Milan, so in Italy. I'm just giving you one line of background. I've been investing in crypto for 3 years now. I'm basically what is called a hodler. So I'm just investing, well, I'm investing mainly in Bitcoin and Ethereum, and I've been participating into some of the ICOs with not so much satisfaction in terms of return, talking about the ICO, but clearly they were very interesting to better understand the crypto space. Just recently, since I'm not trading, I've never had the interest in the stable coins. Just interesting, I'm discovering the importance of them. Especially was shocked by the importance they have in terms of percentage of the transaction in Ethereum, for instance. So how really they got importance in this market. And but I'm also concerned about the attitude that the authorities have, because particularly for the Bank for International Settlement is suggesting that stable coins should all be somehow controlled by central banks. So all the nations are investing or investigating the space of stable coins. And my impression is that they want to keep the stable coin space for national states and not allow privately held or privately controlled or more generally blockchain stable coins.
Okay, Luca.
I just wanted to have your opinion on this.
Okay, thanks, Luca. And
Thank you.
Also, you will hold, if you can get your questions in 30 seconds that way too. I mean, and we like the background. Thanks for giving us your background, because it's always helpful. But to answer that question, which effectively, what the authorities, including the Bank of Settlements, are thinking of crypto, and we'll start with Joao. You got what are your thoughts?
Yeah. I think Luca's point is a good point, and since the beginning, it's a question that we attempted to answer with the collaboration that we typically do with regulators. Is what is the appropriate regulation for this space? We do believe that regulation is required. This is serious enough a piece of financial, global financial infrastructure that it has to be regulated. The question is how. We don't want to also deter the innovation in this space. I think Facebook and Libra last year was good for the space because it forced a lot of conversations, and now we're seeing more clarity from regulators around the world. I think a lot of people are saying that these regulations are going to come in and they're going to be negative for the space. Our interpretation is that they're actually going to be positive. They're actually going to promote a lot of clarity for companies operating in this space.
Okay, thanks for that, Joao. Ryan, what are your thoughts in terms of the regulators and stablecoin market?
Yeah, I mean, I think Joao pretty much covered it. I don't think I have much interesting to add.
Okay, Ganesh, do you have any thoughts to add?
Yes, so I mean, I think there's a critical distinction where the coins that BIS report are thinking about are more along the lines of Libra. So there are a couple of points I wanted to make about Libra are that in their current white paper, they don't really have a clear way to think about having sufficient reserves. And they also don't have a lender of last resort. So these are a couple of important things that regulators are worried about, is what are the kind of emergency contingency plans these coins have in the case that they suffer a run on their currency. The other point is there are like financial stability issues where if these coins get used up too much, or there's a wide scale adoption of, say, a Libra USD, then residents of a small country might just substitute away from the sovereign currency to the Libra USD. And then you can have financial stability implications where the central bank of the small country loses power of monetary policy. Banks also lose the power to make deposits. And so there's a lot of financial stability issues in terms of whether it would affect the health of the banking system when you have this substitute stablecoin currency. So that's, I think, the main sort of issues that regulators are thinking about.
Okay, terrific. Thanks, Ganesh. Our next question comes from William. William, you got to, I think, unmute your microphone.
Yes, I am. Can you hear me?
Yep, terrific.
Yes, thank you. So quickly, why are there not too many services right now that use the stable coins in terms of merchant services or DeFi services? Because isn't that also the end goal besides having the stability?
Okay, thanks, William. Ryan, what are your thoughts on that?
Yes, the question is what services? Sorry, I heard the DeFi part. What was the first one?
Yes, services. Like, why can we not use stable coins in merchant services, all kinds of online services, DeFi types of products widely?
Right. So I guess I'll leave the first one to Yao. But as far as like DeFi, we are actually seeing stablecoins being used in DeFi services. So you think about lending markets like Compound or synthetic asset creation like Synthetics, or even exchanges like Uniswap. You are seeing stable coins like DAI, and then even like some of the fiat collateralized ones like USDC and soon to be Tether being used for these use cases. And I think that'll continue to be a thing because, one of the, I guess, hurdles that many DeFi applications have is that in order to use them, historically, you had to use a volatile cryptocurrency to interact with those projects. So being able to use a stable currency like USD that makes the user experience a lot more seamless for people to use, and it's a lot more familiar when you don't have to worry about whether or not the currency you're using to transact in is going to crash 50% overnight.
Ganesh, want to add anything to that?
So I'm not familiar enough with the payment services, so don't have anything to add.
Okay, Joao?
Yeah, I agree with William on the assessment, but our perspective, looking at what's about to happen in the market is that this is about to change, and I think 2020 has been tremendously interesting. So first of all, as I agree completely with Ryan, so I think DeFi has been very interesting in 2019 for stablecoins. It has actually been a huge catalyst for growth, and if you think about protocols like Compound, they're one of the largest balances of USDC these days, for example, behind a few of the top exchanges. So there is significant use. Granted, in the grand scheme of things, stablecoins are still not large enough. So somebody holding $90 million is not that big, but it's already significant. The thing I would say though, in terms of merchant services and Circle services are part of that growth. The interest that we have seen in 2020 is we are fascinated because it primarily comes from what traditionally we would call non-crypto industries, right? So it has to do with a supplier of a manufacturer of suitcases in China that wants to use USDC to have cheaper access to supply chain payments. It's merchants willing to take payments in various forms and have settlement in USDC.
How do they learn how to do that?
Well, I think through our services, that's one option. Coinbase Commerce has seen tremendous traction on
it. Hey, guys, have you heard about this thing called stablecoins? You just sitting there taking calls in?
That's a good question, Lou. We haven't actually had the chance to, broadly get to the market and educate the market yet. I wouldn't say we are responsible for that. We're doing our part, but it's still a tiny drop in the bucket. A lot of this is really inbound. It's really these companies learning about stablecoins. I think what happened in March, I think the financial crisis that we're going through is also pushing people to try and utilize dollar-based assets a little bit more. And then I think, after some research, they realized that dollar-backed stablecoins are a good way for them to do that in all these jurisdictions where typically people don't have access to dollars. So while I agree with William that you don't see that, I also see the movement in the market tells me that this is about to change, and this might actually be a great year for them.
Super interesting. Our next question is from Anna. And so Anna, you got to unmute your microphone. There you go. Okay.
I did that. So my question is primarily to Ganesh. I was very much interested. You were talking about the arbitrage mechanism, and crypto coin markets generally are seen as very inefficient, with high barriers to entry and with multi-market price discovery. So basically, arbitrage is seen as not working well and not able to remove the inefficiencies. So I was wondering, do you think that in terms of stablecoins, the market for stablecoins is more efficient?
Yes, so it has been drastic change since the Ethereum blockchain. So since Tether migrated to Ethereum blockchain, the average deviations became much smaller, and the half-life, which is the sort of speed of adjustment back to the peg, is faster. So that was one kind of major change, which enabled more investors to access the Tether treasury to be able to make arbitrage trades. I think that as another thing that could improve efficiency of these markets is the addition of a forward market, so derivatives in stable coins, and that would attract additional arbitrage capital, where you could actually do a forward spot arbitrage, which doesn't require you to transact directly with the Tether treasury. So that would introduce more arbitrage capital, which would increase efficiency. But and another distinction to make is between dollar-backed coins and crypto collateralized coins. So dollar-backed coins, for the most part, are performing quite well, and they are able to maintain sort of the peg over even short horizons. The crypto collateralized coins are less able to maintain the peg. So that's mainly because there's no real arbitrage mechanism, because the collateral, which is Ethereum, fluctuates a lot. And so they have these additional stability tools, but they're not able to precisely target like the peg of one. But there's been a lot of increased like efficiency of the crypto market like over the last year to 2 years. So I do agree that there might still be law of one price deviations, like on exchanges in different countries, for example, and that is likely due to like capital controls or other issues. But for the most part, I think the stablecoin arbitrage mechanism is working quite well.
Okay. Thanks for that answer, Anna. Thanks for the question.
Yeah.
And we're going to finish. I'm going to ask the last question. Just again, if you guys each keep it to a minute here, if you've got anything that's not even actually about stablecoins, but certainly the question of the moment is, you guys want to give a quick opinion on Bitcoin, and if you think there's going to be a more impact from the halving. And we'll start with Ganesh, then Ryan, and we'll finish with Joao. So Ganesh?
Okay, so this is a very interesting topic. Everyone has an opinion on the Bitcoin halving. I would say that it's not as, like, a lot of the speculation surrounding it is because the reward rates getting cut by half, so supply growth goes down, then the price should increase. But if you think about supply growth rates, it's not changing substantially. I think it's going from like 3% to like 1.5%. So it's not like a huge decline in the scheme of things.
About a halving.
Yes, but in an annualized rate, it's not like a huge reduction in the annualized growth rate of Bitcoin supply. But my belief is that if it should, like, the Bitcoin price should not change substantially unless there's a speculative boom. And one difference between the 2016 halving and the current halving is that we have futures markets. So if the Bitcoin price goes way above fundamental value due to a speculative boom, people can use the futures markets this time around as a way to kind of bet on the Bitcoin price coming down. So I think that's one distinction to make.
Okay, terrific. Thanks for that. Ryan?
Yeah, so we Masara, we actually just released a Bitcoin halving report today with Bitstamp that it's like a high-level review of what the halving is, what are some of the investment theses, and then some of our opinions. So as far as my take, I think if there's a tagline, it's great marketing, but the fundamentals behind the bull cases are pretty weak. So what do I mean by that? So, the most popular bull case for the halving is the stock to flow model. And one implication of it is that it implies that, bull runs can be sparked by the design of an issuance schedule. So, think billions of dollars, if not trillions of dollars, bull runs can be designed through the issuance schedule. I find that hard to believe. I think the second one is the reduction in miner selling pressure from the block reward being halved. And there's different ways that you can kind of put what that is in context by comparing it to exchanges liquidating their Bitcoin balances, or how much new net inflows would be needed to offset miner selling. But the burden of proof is on people to prove that that is affecting the price significantly. And more importantly, for the fact of the matter, are miners really the thing that's holding Bitcoin back from its next bull run, which I think, it's likely not the case. I think the last point is that, when you put historical Bitcoin halving returns in their proper historical context, the returns are not that differentiated from, what an investor could have gotten from investing in Bitcoin at pretty much any time in its life. It's almost always been a good time to invest in Bitcoin. So yeah, like I said, fundamentally, I don't think it's that big of a deal, but what is interesting is that, you have Bitcoin tightening its issuance schedule, down to that of gold's at a time when you have incredibly loose, monetary policy around the world. So to the extent that drives interest in Bitcoin, I think that could be bullish, but it's not something I would bank on.
Okay, terrific. Thanks for that, Ryan. And the last word goes to Joao.
Yeah, I'll be quick. I won't attempt to give a more technical answer. I think Ganesh and Ryan were great at that. I think it's probably priced in, and I wouldn't do anything specific because of that event. The last thing I would say though is I fundamentally believe in Bitcoin. I think it's one of the biggest transformations we're going to look back in the last number of years, and don't think the halving is going to change my appetite for continuing to hold to my Bitcoin for sure. Okay, well, terrific. I completely agree with that. And I'd like to thank our speakers. I thought it was a great session. As I said, I'm going to be putting this up on YouTube tomorrow. I will write it up over the weekend about the 5 or 7 or 10 things I learned, because I thought it was a super thoughtful discussion. So I'd like to thank you. And with that, we're out of here. Thanks, Lou.
Thank you, Lou, for organizing this.